welcome to our November 2024 macro webinar focused on election consequences. Uh, Taking a step back, a lot of you have heard me talking a fair amount about how monetary policy was indicated to be over easy as a function of the Fed's steps to really rewrite its reaction function in September. One where the focus was really on creating accommodative monetary policy or easing aggressively, despite the fact that economic conditions were acknowledged to be pretty strong. The primary outcome of the election is a likely doubling down of easy fiscal policy. What you see over here on the right-hand side is the fact that if you go through the campaign rhetoric and add up the size of the various proposed policies, what you see is that they are likely to be expansionary relative to sort of the CBO baseline, which is sort of a basic baseline, sort of stable deficits. They're likely to be expansionary. And the primary reason why that is that you've got a combination of the TCJA tax cut extension with an additional corporate tax extension and a series of progressive, maybe you might even say populist tax cuts that are likely to go to high propensity spenders, and that's more than offsetting what is likely to be a drag from the prospective tariff increases, along with a few other elements like cutting out waste and fraud. You add it all up, and what you see there in the center is odds are, if you just take these policies at face value, that the deficits would, over the course of a 10-year time frame, increase by $7.5 trillion, or about $750 billion a year, which would be a substantial increase, about a 30% increase based upon this campaign rhetoric. Now, you don't necessarily want to just draw a straight line between campaign rhetoric and policy implementation. So it's important to start to wrestle with some of these policies, whether they're likely to actually get implemented or not, and what would be the macroeconomic consequences. But before we get that, just a quick review of where we are in the economy as we're coming into this prospective set of fiscal policy changes. The basic picture in the economy, we've been saying it for 2 years. It's basically unchanged, which is on the left-hand side, you see there that real GDP is growing at 2 to 3%. You're seeing nominal GDP growing at 5 to 6%. It's basically been that way for almost 2 years now. And you're seeing, because of that growth, you're seeing the GDP gap, which is really a measure of the level of economic activity relative to sort of a long-term trend or long-term potential, is at its highest level in an extended period of time. When you look at employment largely aligns with what you're seeing in economic conditions, with the employment rate, or the share of prime age workers that are working, is basically, roughly at 25-year highs. And you're seeing very timely measures of employment continue to show strength in the labor market, or I should say, basically no signs of deterioration on a timely basis. And so growth is strong, employment is strong, financial conditions are very easy coming into the election, with spreads now at multi-decade lows and stocks rebounding and continuing their ascent that they've been on, through the course of the year and really for the last couple of years overall. And we're continuing to see that basic picture of a substantial income-driven expansion that continues to press on and is very sustainable, given the fact that it doesn't require a big buildup of debt, and it doesn't really require a substantial easing of monetary policy. It's just set to continue along. Now, paired with that is the fact that inflation remains above the Fed's target. Over here on the left-hand side, we see core PCE, which, the reality has basically been stabilizing around 2.7-ish% on a year-over-year basis over the course of the last 6 or 8 months. And so you look at that, and, that is not 2%. and it remains elevated compared to the Fed's target. And on the right hand side, an important driver of that is the fact that wage growth remains a point or two higher than where it was pre-COVID. And so the only way for that to work is if you have a circumstance where productivity growth is radically better than where it was in 2018. And while productivity growth has been pretty good, I think what we're seeing is that it's not quite enough to make up for the fact that nominal wage growth remains pretty elevated. And so that's the basic structure of the economy right now. Is, coming into this period, we have a pretty strong economy, elevated inflation relative to the Fed's mandate, and the Fed basically pursuing an over easy monetary policy. And the question is, the question really was in the last meeting last week, whether or not Chairman Powell was going to essentially endorse a continuation of this policy. And the combination of the cut plus the rhetoric, I think, really did align with the idea that, the direction of travel of rates is clear. The Fed is cutting, and it's okay that the economy is strong. The Fed is happy to cut in part because they believe that inflation is fully beat, despite building evidence to the contrary. Now, I think from a timing perspective, this is very interesting because the Fed and Chairman Powell in that meeting made the very explicit comment that the Fed was not going to make any effort to consider prospective fiscal policy until that policy actually transpires. And even more so until that policy, the effects of that policy start to show up in the macroeconomic data. What this means is that even though there's some indications that fiscal policy is likely to be expansionary in a new administration, uh, the fact that that will happen will not meaningfully influence the Fed's behavior in the interim. And so the Fed seems relatively committed to continue this easing cycle, despite the fact that there may be a large fiscal impulse, a positive fiscal impulse in the future. Put that together, and we could easily see a setup akin to the failure of transitory that we saw a couple of years ago, where the Fed is cutting, creating, basically further energizing an already strong economy. And then on top of it, we've got a set of, prospective fiscal policies that would add fuel to an already hot economy. And so that's really the story. The Fed is really going to be the primary driver over the next, let's say, 6 months. And then once the new administration is installed, it's going to take some time for their policies to both get implemented and then also get executed and have macroeconomic effects. And so we're probably not seeing the impact of those prospective fiscal policies until the second half of 2025. So let's get into it. What do these policies mean? What is it? What is possible in terms of the different policies, and what is likely the macroeconomic impacts? Well, I'll start with actually one of the easiest ones to take a look at or to think about from an implementation perspective is a shift in the regulatory framework. Already there was an erosion to some extent in terms of the regulatory control of agencies relative to essentially executive direction, but under the through the Chevron case, and so that was already kind of in place and in the background. And then on top of it, what we have is administration that is likely to further push those conclusions to move towards a lower regulatory environment. And while these things can be can sound marginal, the reality is, particularly like from a supply side standpoint, incremental regulation loosening can have a relatively material impact on economic conditions, maybe not in an instantaneous way, but over time. And we're already starting to see that flow through into what we're seeing in terms of equity market action, particularly with banks really getting a big benefit from the banks and financials really getting a big benefit from the prospective loosening of regulatory conditions. Of course, it's one of the most highly regulated areas of the economy. Giving some latitude to these financial institutions will likely create and support further lending growth, which, at this point is at recession lows. And so it wouldn't take much to create an incremental support to credit growth there. On the energy side, the effects are a little bit more offsetting for oil companies in particular, where the regulatory loosening largely aligns with increased production as environmental regulations are likely to be rolled back. But at the same time, those companies are likely to see better incremental profitability as a function of lower environmental regulatory thresholds. And so we actually saw a pop, despite the fact that expectations are for greater oil production under a new administration. We actually saw a pop in those companies as a result of the election dynamic. And so this basic regulatory infrastructure, it's really important to recognize, because this is the sort of thing that can change essentially instantaneously, and it can be relatively substantial. I mean, estimates are that regulatory impacts on production might have been as significant, as $500 billion on an annualized basis in terms of the overall impact on the economy. If that goes to something that's closer to zero, that was in 2024, after a few years of being kind of a $200 billion incremental impact. If that goes, basically to zero in a new administration, or even negative prospectively, you could easily see a circumstance where that would be meaningfully supportive to growth ahead, in many ways more so, or at least on par with some of the dynamics that might be happening with the sort of direct fiscal authorities. Turning our attention now to the TCJA, which, given the fact that, probabilistically there's an R sweep, the TCJA is likely to be extended. Its primary impact is to extend tax cuts to higher income individuals, concentrated higher income individuals, which, of course, with a lower marginal propensity to spend, are likely to see, it's likely to have a modest impact on growth. And important to recognize that, the TCJA is the current law of the land, which means that an extension only has a marginal incremental impact. It has a meaningful impact relative to the CBO baseline, because that baseline has been determined based upon expectations that it would be fully rolled back. It would roll off at the end of next year. But from a macroeconomic standpoint, an economic standpoint, what matters is how much the tax rate is changing on the margin relative to where it was before. And there, simply an extension would have a more muted effect. And you can see here on the right-hand side, various models trying to pencil out exactly what the impact would be in the short term. The short story is it's going to be a marginal positive impact when it is extended, likely next year. The real question when it comes to the fiscal expansion is whether this series of substantial progressive effective tax cuts are actually going to be implemented, or are they just campaign rhetoric? If you look at things like exempting overtime income, not taxing Social Security benefits, or exempting tip income from taxes, plus some small business support as well, those are all supports that are pretty directed towards those folks in the economy that have a very high marginal propensity to spend. And so, if you cut the taxes on Social Security as a simple example, the odds are essentially dollar for dollar that that'll get spent by the vast majority of individuals. And so that essentially is a pretty direct injection of economic support into the economy. And on top of it, the lower corporate tax rate for businesses, particularly focused on domestic production, and you've got an additional support for U.S., not just the U.S. economy, but you've got a support almost directly for the U.S. stock market, which is could be a relatively substantial support, something like 8%. You add it all up, And the year one impact of this suite of programs, at a midpoint could increase growth, could be a 1.4% positive growth impulse on the economy. That's a pretty substantial positive growth impulse were these things all to be implemented at the same time in 2025. And so it's not to say that they necessarily will be all implemented, but I think this is in many ways one of the key outstanding questions is, are we going to see a reaffirmation of the campaign rhetoric that was so focused on on these efforts to create tax cuts for lower income earners? Now, of course, on the offsetting side of that, there's a fair amount of questions about whether or not tariffs. Actually, I'll go into one more thing before we get there, because I do want to. On the positive side, we'll sort of round out the positive side. I think it is an important question about whether the political environment further incentivizes, both explicitly and implicitly, domestic investment, which could easily have a relatively substantial effect. On the left-hand side, what you see is private fixed investment in non-residential structures as a share of GDP, and what you could see is, it can be a relatively substantial portion of GDP on an annual basis, and so. I think that's the real question is, are we likely to see, an increase in manufacturing investment and capacity? And similarly, on the right-hand side, what you're seeing is something that gives some indication of what's going on with intellectual property investment as well. And so, will we see, as a function of a lot of the questions, a lot of the supports for the sort of policy environment that not only very explicitly incentivizes, certain activities, but will implicitly support an increase in activity, domestic activity, and domestic investment activity. Offsetting this, of course, is the tariff framework. And what I'd say is there's a lot of questions about the tariff framework in terms of what is actually likely to be implemented. If you take it at face value, what I'd call the 60-10 program, which is a 60% tariff on China, all Chinese goods, and a 10% tariff on all other imported goods, what you'd be looking at is the highest tariff rate since World War II. A tariff rate that is unusual in the modern day and not unheard of if you look back through history. All told, it would add up to about a 1.8% drag on U.S. spending, or 1.8% increase in incremental income to the government as a function of the tariff policies, of which about 1.4% of it would be incremental new tariffs following the 2018 and 19 program that was put in place. And from a revenue side perspective, it would modestly increase revenues. It's just important to recognize that through the process of increasing the tariffs, odds are that there would likely be a substantial reduction in sourcing goods from those jurisdictions. So, for instance, sourcing goods from China, let's say, whether explicitly looking for alternative production or production moving through other jurisdictions in order to get lower tariff treatment, odds are more likely than not, you're not going to see that 60% tariff on imported goods from China fully flowing through because of the fact that, you're going to see some reduction in the amount of goods produced by China if they're really tariffed in that way. And so the effective tax increase is likely to be lower than sort of initial expectations as a result of the fact that you're going to see those contractions. And so that's where you see about $300 billion of incremental impact, which on a percentage GDP base is about between 1 and 1.5%, depending on how you add it up. And so that's kind of how it works out. So the actual income, the revenue raisers that you're talking about at $242 billion plus, 53 billion, et cetera. You're talking about $230 billion of revenue raisers, give or take, which is in a given year, which is pretty small relative to the magnitude of these prospective cuts in taxes and other supports, which is, something like 400 billion a year. So it's not quite enough to offset the campaign rhetoric, the proposed policies that are supportive to fiscal expansion. Of course, tariffs, they have an outsized growth impact relative to the size of GDP, and the reason why that is because they would almost certainly act as an effective tax hike on middle class and lower income cohorts, because those are the cohorts with higher propensity to spend out of their income. And on the left hand side, you can see how that is distributed, very heavily concentrated, so a very regressive tax towards lower income cohorts, which would magnify its growth impact were it to be implemented fully. And on the right hand side, you see a sense as to what the prospective impact would be on inflation. And what you see there is, I think, the shorthand, which is certainly right in the rough order of magnitude, which is every 1% increase in the effective tariff rate would add about 0.1% to core PCE inflation. And so if you come over here, you're looking at about a 20% rise in the overall tariff rate of the U.S. economy, leading to something that looks in the ballpark of about 1.5% to 2% increase in core PCE were these tariffs implemented as promised in the campaign. Now, look, I think there's a lot of questions about whether the tariffs will actually be implemented as described. Certainly, many folks look at this and they'd say, this may be a bargaining chip, this may be a negotiation tactic. This may be phased in over an extended period of time as a way to extract concessions. So in a lot of ways, there's a lot of uncertainty here about what that range is. And really, if you just take a step back across these two things, there's a pretty big range of uncertainty here. Everything from, essentially a zero tariff environment with all that fiscal stimulation could be a 1.5% support to growth, or it could literally be about a 1.5% drag on growth were you to get very little in terms of those progressive tax cuts, and you got 100% implementation of tariffs. Now, I think when you look at what's most likely to transpire, and 2016 is some indication, as has been the rhetoric, let's say some indications so far in terms of the policy priorities, it's very likely that you're going to get some real focus on some of those cuts that were discussed, tax cuts that were discussed, and that tariffs would be a more slow-moving activity. But this is a sort of thing where you don't need to predict this to get ahead of it, because what you need to do is have a good understanding of what the magnitudes are, so that when the policy becomes clearer, you know how to react and you know how to compare it to what's priced in. Similarly, there's some questions on the immigration side of things where, there's been campaign rhetoric would suggest a relatively substantial effort to remove unauthorized workers in the U.S. economy, in addition to closing the border. I think it's important to recognize that the border has already pretty much been closed, with the encounters in the southwest border meaningfully falling over the course of the last 6 or 8 months to levels that were not that far off of where we were in the pre-COVID period. And so you're not likely to see, much in the way of meaningful additional slowing. I think it's part of the reason why we've seen some of the employment numbers, the headline numbers, be a little softer, even though things like the unemployment rate has chopped sideways and claims have remained pretty low. The real question here is whether there's a meaningful effort to remove, upwards of 20 million unauthorized workers in the U.S. workforce. Obviously, that could have huge effects, both in terms of direct income and spending from those cohorts. It's basically, if you take a worker out of the economy, it's like a dollar for dollar impact on economic activity and spending. Not to mention, the disruption, the second and third order consequences of the disruption associated with it. So the real question is going to be how much effort and how significant is, the slowdown of border encounters, and incremental immigration has largely fallen, close to 0 cent, literally zero, but it's pretty close to it. So there's not a lot farther for that to go. The real question is whether there's going to be large deportations. Again, the jury is meaningfully out on that account. Another element of prospective policy drags is what's going on with spending, and there's been some efforts to outline a Department of Government efficiency that could make efforts to reduce overall federal government spending. Now, it's really important to recognize here that the vast, vast majority of the $7 trillion of spending, or $6.1 trillion, depending on exactly when you're looking at it, of spending by the U.S. federal government is in mandatory spending programs like Social Security, Medicare, et cetera. It will be very difficult without congressional authority, certainly, and difficult regardless, given the political environment, to cut that spending. And so what you're really talking about is focusing on the 1.7 trillion of discretionary spending, of which something like 50% of it is military related spending. And so now we've shrunk even further, basically down to about $700 billion or $800 billion of non-defense discretionary spending, which of course could see some degree of cuts. But just when you're thinking about the orders of magnitude that this is likely to have in terms of the effect on the economy, there's only, the federal government non-defense employment is only roughly 1% of the workforce, a touch bigger than that. So there's not a lot of, there's no huge cuts here. The idea that the U.S. government's going to cut $2 trillion on an annualized basis, that's just fantasy. That's not going to happen. Because it would require, not just zeroing out discretionary spending, but also radical cuts to Social Security and Medicare. So that's not going to happen. That is campaign rhetoric rather than, reasonable prospective policy. We talked about this. And so the question from a macroeconomic standpoint is not just will the prospective policies create a support to economic conditions. The larger deficits, including those that are proposed, which you see here over on the left-hand side, would add to the financing burden of the United States. And so the question then is, how much would that increase the financing costs? Because, of course, the benchmark U.S. Treasury curve remains essentially the foundational cost curve for the economy when it comes to, various borrowing in the economy. And there, what we see in the scheme of things right now is that borrowing costs in the U.S. economy are not that high, and certainly if you look at term premium, they're also not that high. And so part of what's happening here is that the U.S. is much stronger than the rest of the world, has higher interest rates than the rest of the world, and what's happening as a result of that is you're seeing a fairly significant flow of capital from the rest of the world, the slower growing, lower yielding rest of the world, into U.S. assets, which is helping keep a lid on term premiums of U.S. assets. Now, that's important because what it means is that even if the U.S. deficit starts to rise again, there's still a heck of a bid that's out there. And that would only be further exacerbated to the extent that the yield curve starts to steepen, which creates incentive to ride the curve, particularly from foreign investors. So could we see a circumstance where U.S. interest rates rise, say, to 5% or a little bit above 5%? For sure, that absolutely could happen. But the idea that we're going to draw a straight line to something meaningfully higher than that seems improbable, even with relatively, incrementally expansionary fiscal policy. And of course, always important to recognize that when you're thinking about interest rates, particularly interest rates on, when you're thinking about the interest rate curve, to the extent that you see interest rates move in a way that is inconsistent with underlying economic activity, the Fed, of course, has essentially unlimited firepower to go in and purchase the bonds. That put, it's really a put on the bond market. We talk a lot about the Fed put in the stock market, but the Fed has drawn, has a huge put in the bond market, which means that the odds that you see, an acute rise in yields, particularly one that is meaningfully inconsistent with economic conditions, is pretty low. And so I'd say, this circumstance, which is, could you run deficits that are 6, 7, 8% of GDP for the next 4 years? For sure. That is a pretty incremental impact on the overall debt profile of the United States, the interest expense, et cetera. It doesn't mean that over the long-term perspective, the current expectations of borrowing capacity aren't sustainable. You know, they probably are unsustainable, but the issue is over the short term, this level of borrowing is probably doable. And because that expansionary fiscal policy would come in, it would likely, I should say, if the rate rose because the deficits were larger as a function of expansionary fiscal policy that was supporting growth, the economy itself would likely be able to handle higher interest rates because of the positive growth impulse. So you put that together. I don't think there's really a question about whether or not the federal government can finance its deficits. I think the real question here is whether or not the policies are going to be implemented that are going to be expansionary. The big picture story here, if you just take a step back, is we continue to have this relatively easy Fed policy penciled out for the next couple of quarters. It looks like we're going to get easier fiscal policy when you think about all the different levers and the probabilities of them. And you put that together and you look at what's going on with the pricing of assets, particularly stocks. There's lots of stuff, let's say, that's Trump adjacent that has rallied a lot right after the election. But if you look at the economy-wide level, if you look at the S&P 500, it's only moved a few percentage points up since the election. And so it is really important to recognize that to the extent that these sorts of pro-growth influences come to fruition, it's still pretty modestly priced into the equity market at this point. And so that's sort of where I'm looking at it and saying, are we getting incremental information that would align with confirmation that these policies are likely to get implemented? And if so, it's probably underpriced in equity markets at this point, and to some extent in bond markets, meaning yields probably would need to be higher.